In trading, we've all already wondered what is the best way to identify the highs and lows on a chart before a price reversal. And in my opinion, one of the best ways to achieve this is to use what are called divergences. Yes, behind this little word hides immense potential that could clearly change the way you enter or exit a trade. So today we will see what divergences are, what they are used for, and how to use them. At the end of the video, we will even test a strategy that uses them. So stay tuned, because what I'm about to teach you today could very well serve you in your next trade. First of all, what is a divergence? Well, it is a difference in direction between the price of an asset and a technical indicator over the same period of time. Typically, this can be spotted on oscillators like the RSI, the stochastic, or the MACD. To illustrate this, let's look at a concrete example. Here I have a chart of gold on a 1 hour time frame. And as you can see, between this moment right here and this moment right here, price increased and made a new high, which was higher than the previous high. So in other words, this second high here, this candle, closes higher than the previous high that we had here at the candle close. But look what happened on the RSI over this exact same time period. Here on the RSI, the first high was actually higher than the second high. It will be even more obvious if I use a line chart. As you can see on the line chart of the price, the second high is clearly higher than the first high. Price is increasing. But on the RSI at the exact moment, the second high is lower than the first high, and actually the oscillator is decreasing. And this is what you call a divergence. In other words, the direction of the price and the direction of the oscillator are divergent on the same time period. As a reminder, the RSI is an indicator that measures the relative strength of the buyers compared to the sellers. To do that, it looks at a certain amount of candles and sees how many were bullish versus how many were bearish. And the bullish one, how big were they compared to the bearish ones? And it computes that to give us a ratio between 0 and 100. If the RSI is above 50, it means the buying strength is dominant. If it is below 50, it means the selling strength is dominant. And the higher the RSI, the higher the buying strength, and conversely, the lower the RSI, the lower the selling strength. And that is why when you look at the price chart and the RSI, these two lines are identical. They follow each other. When the price rises, the RSI also rises. Then when price declines, the RSI also declines. And we see the same highs and lows on the price chart and on the RSI. And that makes sense, because if the price is increasing, then that must mean that the buying strength is also increasing. So that will show on the RSI over the exact same time period. Same thing, if price is decreasing, then that must mean that the selling strength is increasing as well. So the RSI will go down and it will show on the oscillator. So almost all the time, the price and the RSI will move in the same direction. And I say almost because sometimes you have these kinds of discrepancies where price makes a lower low. In other words, price decreases over a certain period of time. But when you look at the RSI over the exact same period of time, you can see that the RSI doesn't make a lower low, but makes a higher low. And here we have another case of divergence. And how to interpret this discrepancy? Let's go back to our first example right here. Here we have price making a higher high, but the RSI showing a lower high over the same time period. That means that the buyers managed to push the price higher to this point, but the fact that on the RSI, the value was lower than during the first high here, it means that at that moment, buyers had less strength than when they made the first high. And this sends a warning sign that potentially buyers are running out of breath and lacking momentum, and that maybe a reversal could come. The case that we have here, where price prints a higher high, but at the same time the RSI prints a lower high, this is what we call a bearish divergence. Bearish because since the buyers are suddenly showing signs of fading strength, this could lead to a bearish reversal. And the other case that we had here, where price makes a lower low, but at the same time on the RSI we do not have a lower low, but we have a higher low, then this one, as you can guess, is a bullish divergence. Because here, the sellers are potentially losing strength, which could push the price higher. And now if I go back again to our first example, we have something very interesting here actually. Let me quickly clear this up. We have what we call a double divergence. Because look, price made a first divergence here, which I explained before, but then it made another higher high. But look at the RSI at that exact moment, it was even lower than during the previous high. And then again here, so it's even a case of a triple divergence. Let me illustrate this. We have another, like the last high that was made here on the price. Look on the RSI now, it was actually the lowest high over all these previous highs here. And that phenomenon, when it occurs, a double or triple divergence, is an even bigger warning sign of fading strength and fading momentum, which clearly increases the odds of a reversal coming, which is actually exactly what we had here on gold after these multiple divergences, the price completely reversed. And these kinds of double or triple divergences will show on any chart, any asset, any time frame. I just pulled the 15-minute chart on Bitcoin and noticed that we had a double bullish divergence on the RSI. As you can see here, we made a lower low, then again a second lower low, lower than the previous one. But at the same time, on the RSI, the price printed higher lows. So this was here a double bullish divergence before this big price push here. But there is something you've got to be very careful about. A divergence is not a guarantee of immediate reversal. Instead, as I said, it should be seen as a warning signal that tells you, watch out, price is continuing to rise but with less and less strength. Or conversely, watch out, price is declining but with less and less momentum. One thing that is very powerful and interesting with divergences is that you can see them in real time. Unlike other indicators which are lagging, where you can actually see what you should have done way too late, look what happens with divergences. For example, here on the price of Bitcoin, we can notice that Bitcoin, when it made on the daily chart the highest close ever at the time, so a higher high, at the exact same moment on the RSI, we could see a divergence. And if I go back in time using the replay mode, we could see that as it was happening, as if we were in real time on the charts, we could already spot the divergence at that time, and thus get the information that momentum is fading while it's happening. And a couple of days later, when price made a new higher high, and we saw that there was actually at the time now a double divergence, then this is another signal that we could interpret while it was happening. So if you can combine this information with other technical elements, such as, for example, price being in a supply or resistance zone, or going on lower time frames and see a market structure shift, this could greatly increase the odds of price actually reversing after you spot the divergence. And analyzing things this way can greatly increase the quality of your decisions. In other words, using your favorite price action concepts or other technical tools while divergences are occurring, it adds a lot of confluence to your potential trades. Let's now see some rules to identify divergences that are valid. The first rule when drawing valid divergences is to only connect close prices and not highs and lows. This makes sense because indicators, including the RSI, in their calculations, they take into account the close prices. So if we want to see a divergence between the price and the RSI, we have, just like the indicator, to use close prices. Rule number 1, use only closing prices. It is not relevant to use wicks because we want to identify a discrepancy between what the indicator shows and what the price shows. And indicators like the RSI, the MACD, or stochastic are calculated only on closing prices. So the fact that a candle had a long wick, for example, it's not reflected in the RSI value. And that is why only close prices should be used when you draw your divergences. Rule number 2, when you connect two low close prices, or for example, two highs, but still using the close price, that line that you drew must not cut through another candle's body. Cutting through wicks is okay because actually wicks are invisible to the indicator. If we used a line chart, there is no wick there. But if the line that you drew cuts through another candle's body, then the divergence is invalid. The same applies to the RSI curve. The line connecting the 2 points must not cross through the curve elsewhere. So basically, when you drew a divergence, if you go now on a line chart, you must not see your line cut through the price line. And same thing on the indicator, you must not see your divergence line cut through the RSI line. For example, saying, oh, I see a divergence here between this high and this high. This one is not valid because if we check on a price line, we can actually see it on the candlestick chart. It cuts through the body of another candle and it cuts through the RSI line. And it's even more obvious on the line chart because it clearly cuts through the line. Rule number 3, don't try to identify divergences that are hundreds of candles apart. Remember that the point of divergences is to identify short-term momentum slowdowns. In the algorithmic test that I did, I usually allowed up to 70 candles maximum between the two divergence points. But most of the time it will be less than 30, because if you have a large amount of candles apart, it's likely that the divergence line will cut through the body of another candle or cut through the RSI line. Longer distances between the two divergence points were quite rare, but up to 70 was not counterproductive. On the other side, the minimum distance is 2 candles. As you can see here, even with 2 or 3 candles, such as this one right there, we had a divergence between these 2 highs. 2 or 3 candles apart is a valid divergence as well. Rule number 4, for higher quality divergences, the first low or high of the divergence, I mean the first point of your divergence, should be in oversold or overbought territory. This is the case here. We have a bullish divergence, and as we can see on the first point of our divergence, the RSI is below 30. It's okay if the second point of your divergence, like your lowest low, is not in oversold itself. But the very first one, the very first low here of the divergence should be in oversold territory. In the case of a bearish divergence, the first high should be in overbought territory. Look at an example here where it's not the case. Here we have a higher high. You can see that the closing price of this candle is above this one, so we potentially have a higher high. But at the same time, on the RSI, we have a lower high than the first one, but the first point of our divergence is not in overbought territory. So when you see that happen, it means that there is still a divergence, but it might be of way lower quality. Now let's talk about how divergences can help you with both entry signals as well as exit signals. That's right, divergences can help you as filters when entering a trade. Let's see an example here for breakout traders. Some traders like to enter when there is a breakout of a recent high or a recent low. So this was the case here in mid-August on Bitcoin. We had the all-time high sitting here. And when price broke through that high with a candle body close, some momentum breakers might be tempted to buy Bitcoin, assuming that a new upwave will start from here. But look what happened on the RSI at the same time. We had a higher high here compared to here. But on the RSI, we can see that we had a bearish divergence happening at the same time. So in other words, we had a bullish breakout, but this breakout was done with fading momentum, which could be an indication that actually this breakout might be a false break and might not work at all. And in that case, this is what happened here. Soon after the breakout and the divergence, we had price completely reversing to the downside. So a breakout trader or momentum trader watching for divergences occurring or not as filters would have potentially not entered that trade here, that breakout trade, because there was a bearish divergence happening at the same time, which is actually a counterintuitive signal. Same thing here when we had a break of this low. At the same time, on this candle, we had actually a bullish divergence materializing, and we even actually had then later a double bullish divergence with the next lows and even a triple one very soon after, which was a sign that as this breakout was occurring, momentum was already fading, which was then confirmed with the double and triple divergence, which is where price then reversed to the upside. And as I said before, the divergences in themselves are not an immediate signal of reversal coming. They're more of a warning sign, which in that case here could have warned the breakout traders that momentum to the downside was fading, so they should not expect much more push to the downside. Another way that I find relevant to use divergences for entries is when the divergence occurs while we are at a key level. So for example, here on Hyperliquid, price had created a demand zones around these lows here, and the next time we revisited this area, we could see that we had a bullish divergence on the RSI happening at the exact same time. So a combination of two factors here, the pullback on the demand zone, as well as the fading momentum illustrated by the bullish divergence. This was like good confluence that this might be a potential good trade location for an entry. So in other words, when a divergence occurs and it is aligned with the direction of the trade that you want it to take, this is the kind of thing that adds confluence and adds odds of your trade working out. Now let's look at how divergences can also help you with your exits. Let's say, for example, that you took this buy trade here after you saw the bullish divergence and a shift in structure. So you entered the trade with a stop, let's say, below the zone. At first, you see price go in your direction. And when there is no divergence, it means that for now, there is no fading momentum. The first divergence you see is actually right here. It's not obvious, but it's between these two highs there. Same thing, as you can see, on the RSI, we have a small divergence occurring. So this could be a potential sign, a warning sign that momentum is fading and an indication to take partial profits right there. Then price continues to rise. There is no new divergence, but we see a new one occurring right here. Here you can see we have a higher high, but on the RSI we have a higher low. So this could be another trade location to take partial profits. And as price then continues to rise, this divergence then triggers again using this same first point. We have, like, as price is making new highs, then we still have the divergences. So by taking partial profits there, and let's say there again, and one final time here, your average exit price is roughly here. And as you can see, this gave you almost all of the upside potential of this move here before price actually reversed. When I said that your average exit price is here, I didn't point, at this candle. What I meant is that your average exit price is roughly in this area right here. So you can use the fact that a divergence is an indication of fading momentum to time your exit, because if you do not see any fading momentum, then there is probably no reason to want to exit too early, because no fading momentum means things are obviously going your way. One other thing you should know about divergences is that not all of them should be traded. Look, I plotted an indicator that shows divergences occurring directly on the chart. And as you can see, not all divergences lead to a reversal, such as this one right here. There was a divergence, but no reversal happening at all after that. On the other hand, this one was a divergence that brought the true reversal and actually happened at the same time as a true local top. Same thing here. We had a divergence that actually led to a reversal afterwards, but the next one that came, this one saw no reversal. So if you want to trade all divergences, know that not all of them will actually lead to a reversal afterwards. But on the other hand, we notice that the true bottoms and true tops that occur at the same time, very often there is also a divergence. So a kind of saying, if I might say, that I want you to remember is that not all divergences lead to a reversal and lead to a true bottom or top happening. But when there is a true bottom or true top happening, very often at the same time there will be a divergence. Do you see the nuance there? That means that if you want your divergences to give you the best odds of having a reversal occurring and divergence being the signal of a potential true top or bottom, you need to combine it with other factors that will also increase the odds of that certain level being a potential top or potential bottom. Let's actually see what happens if we blindly trade all the divergences that occur. Okay, so to do that, I'll go on upside.com and we will create a strategy and test it on gold futures. So here we go, and the rules of our strategy will be the following one. We will say on the 1 hour chart, if there is a bearish divergence on the RSI, and we'll add another parameter, and the ADX is below 30, if we want price to be not really trending, then sell at the next red candle. Conversely, we'll say if there is a bullish divergence on the RSI and ADX is below 30, then we want to buy at the next green candle. So these will be our entry triggers. For our exits, we'll say stop loss at the high or low of the candle that has the divergence. Okay, so this is clear enough, and it will allow us to trade all divergences that occur, the low quality as well as the high quality ones. We'll backtest that over the last 20 years. We will risk 0.2% of our account per trade, and we will not allow more than one trade at once. All right, should be good enough to go. We can start the backtest. Here we go. If you have ideas of strategies that you want to backtest and then automate, you can do all that just like I do on upside.com. You can get started for free and find the link in the description below. All right, the backtest is finished. Let's see what we got. Okay, here are the rules that Upside coded. It's all good. We can see that it's not that great of a strategy. Over the last 20 years, the total return would have been 71% for a max drawdown of almost 45%. So the annualized return is barely 3%, which is not worth trading then. The win rate of the strategy is quite low, but the risk to reward is high, which basically, and we can see it on the equity curve, it's not really the type of trading strategy equity curve that you want over a 20 years period. But that was expected since we are trading all the divergences that occur, so even the low quality ones. And well, basically there's a lot of room for improvement here, but it's not a losing strategy per se, because the expectancy is not in negative territory. You know what? I'm sure you will be able to do much better than this. Now, the goal will be to filter out bad divergences from high quality ones by adding your own elements. But as you can see, in literally 2 minutes, we were able to see if a trading strategy works or not. So have at it. All right, I hope you enjoyed this video. If you did, feel free to subscribe, leave a comment or a thumbs up. As for me, I'll see you in the next one. Bye.